FHA buyers finally get some love, and 5 reasons why the 2023 real estate market is not like the 2008 real estate market. Hey, this is Dave, the Bolduc Realty Group. Welcome to my weekly real estate market update. Today's February 24th. I want to take a minute, say happy birthday to my daughter, Jillian. She's 20 today. Love you, kid. Happy birthday. Before we jump into all that stuff, we want to talk about the YouTube algorithm. Please like, subscribe, ring the notification bell, throw some comments in down below. I'm just trying to get the word out. The data that I'm seeing, it's all database. There's no emotion, no hype here. And I just want to try to make sure everybody understands what's happening and why it's happening out in the real estate market today. Connecticut key metrics, 3,456, 3456 active houses on the market today. That's single family, multifamily, and condos. 76 down from last week, which continues that trend that's been going on for months of inventory dropping every single week. We got 122 coming soon. Hopefully that'll change the direction there. We closed a little under 2,500 in January, 1,500 so far in February. I expect that number to pump up by several hundred as we finish up the month, because the end of the month is always pretty busy. That leaves us with 1.4 months of inventory on hand. And I've got a couple closings this month, and I just wanted to say congratulations to Kyle and Emma. We just closed today, and then Stuart and Brenda were closing on Monday. So congrats to you guys. So what's going on with the FHA mortgages? So the mortgage insurance premium, which is paid monthly for the life of your loan, and it's an insurance premium to cover the lender in case of default, is being cut by 30 basis points, or 0.3%. What does that mean? What that means at the end of the day is for every $100,000 borrowed, your annual mortgage payment is going to be $300 less. So if you did a $300,000 loan, you would see $900 less per year, or $75 a month. So the mortgage payment will be $75 less per month. That's what it really boils down to, which is a significant amount of money. It's new loans only, as far as I know from talking to lenders, and it comes into effect on March 20th. Highly recommend you check in with your lender about if this applies to you or not. But it's certainly a great thing to see. I'm really happy to see this for FHA borrowers. Some key dates that I've been watching throughout, and I'm going to start reporting on them a little bit more. March 10th is the jobs report from the Bureau of Labor and Statistics. The last couple of them have been pretty spicy, so we want to see this more in line with what the expectations are. It's great to see people get more jobs. I don't want to take jobs away from people, but the negative thing, the way the Fed looks at it, is if there's more people working, they make more money, they have more money to spend, so they're going to spend more, so there's higher demand, so inflation goes up. So that's not a good thing when they want to drive it down. The CPI, which is a consumer price index, think retail, is March 14th, and then the producer price index report, which is wholesale, comes out on the 15th. So you'll notice that all of those are before the FOMC, or Federal Open Market Committee meeting, which is the 21st and 22nd. So the Fed's going to have the latest and greatest information when they take a look at this. If these reports are as spicy as the last few have been, because the PPI and CPI came in spicy last month too, if they're as hot as they were, then we're going to see more of an interest rate increase than what's being forecasted. Right now, they're expecting a 1/4 point. I think it's better than 50% chance of a 1/2 point, in my opinion. And if these are as hot as they were last month, then we're definitely going to see a 1/2 point. So hopefully they come in cooler. This chart is showing that over the last 6 recessions, prices go up rather than go down. There's 2 cases where they went down, 1991, 2%, and 2008, 20%. 2008 was an experience for anybody that went through it. But it was driven by the housing market collapsing, not the recession caused the housing market to collapse. We got to keep that in mind. And here are 5 things that say we're not in the same situation. The number of homes for sale in Connecticut in 2008 was 30,000. Very low now, 3,400. It's an order of magnitude different. Equity was low in 2008, high now. What was owed versus what the house is worth was pretty equal back in 2008. Over half the houses in the U.S. today have 50% loan to value or more. So it's a completely different picture. Lending practices, we'll just call them loose in 2008. They're much tighter now. At the closing I was at today, the stack of documents was like that. It's painful, but it's necessary. So it's what we have, and it's making a much more qualified buyer lower risk. New construction peak going into 2008. It's very low now. In Connecticut, we were at 11,000 housing units a year. Now we're around 4,000. It's a significant drop. And then foreclosures right now are at 89% below the 2012 peak. A lot of talk about foreclosures. 30% round numbers below the 2019 numbers. So yeah, they're up from last year, but last year there was a moratorium for 7 months. So of course they're going to be up. But we can see that when you look at more years that are a little bit farther in the past, without the COVID impact, they're considerably down. Foreclosures are very low. A couple of other interesting points. Interest rates are about the same. They were trending down in 2008. They're trending kind of up now. So you would expect if they were trending down that it would help the market, not hurt it. And then inventory is continuing to drop every week, as I talked about. And right now, nice homes are selling so fast, it's ridiculous. I have not been in an offer situation, either as a buyer or a seller, where there's only one offer in years, and certainly not in the last several months. Buyers, they are very picky with rundown homes. They're not interested in dealing with them. So that's why the days on market is going up, because there's about 50% of the houses, they're in terrible shape and nobody wants to deal with them. So they just sit on the market. So moving on to the primary mortgage market survey, 6.5%. It's up a little bit from last week, and we are seeing that trend up. This is the market pricing in the expected Fed funds rate increases. And I always show this slide as well. It's not great being at 6.5%, but it's better than 8% or 12%, or 1981, I think it peaked around 18%. Hopefully this is some value to you, give you an idea what's going on in the Connecticut real estate market today. If you do have any questions, please reach out. Until then, have a great weekend. Thanks a lot.